Investing in exchange traded funds or ETFs can be a great way to generate passive income. Most ETFs focus on either holding income generating assets such as dividend stocks or bonds. Meanwhile, you don't have to actively manage any of the ETFs like you would a portfolio if you're just holding individual stocks. For me personally, most of you know that I do not own individual stocks. We just buy into the ETFs. Now, in today's video, we're going to be looking at the 3 top ETFs to hold for 2024 in May to generate that passive income. The first top ETF that we look like is one of my absolute favorites, which is the SCHD. That is the Schwab US Dividend Equity ETF, passively managed, and we know there was a rebalancing not too long ago. It tracks the Dow Jones US Dividend 100 Index, which of course is the index that measures the 100 high yield dividend stocks that we have with records of paying consistent dividends over an extended amount of time. Now, looking at this, it also provides you a little bit of risk mitigation, because when you think of the VOO like the S&P 500, when you look at the VUG, which is focused on the growth, the SCHD is focused on the dividend income. So chances are majority of the big growth stocks like we see are not paying an exorbitant amount of dividends, which is the reason why, again, it does yield a little bit of diversification. So looking at the top 5 holdings within this fund, number 1 comes in at Texas Instrument Semiconductor Company. 4.1% of this fund's total holding has a dividend of 2.9, which is a pretty decent yield on a dividend, followed by Bristol Myers Squibb, which we know is a pharmaceutical company. 4% in this fund, but has a 5.4 dividend yield. So when it comes to dividend yield, that is a massive, massive dividend yield, and one of the highest that we do see that they're holding in here. Number 3 is Lockheed Martin Defense Contractor. If you haven't heard of them, 4% of the fund's holding an overall 2.7% dividend yield, still paying pretty good, followed by PepsiCo, which is of course the beverage giant, 4% of the fund, 2.9% yield. And then the big one, which is Verizon, we know telecommunication or telecom company, 4% of this fund yielding 6.6%, which of course gives this ETF a high dividend yield because it focuses on the high dividend stocks. But of course, like I said before, you don't have to hold the individual stocks. So instead of saying, let's say, for instance, you want to invest in PepsiCo or Pepsi, you're going to buy one specific one with PepsiCo, meaning that you're going to be locked into one. There could be ups, there could be downs, which is the reason why, again, I don't invest in very specific when it comes to stocks. I only do the ETFs because instead of holding one company that is yielding those dividends, we are holding 100 companies that are going to yield dividends. Now, of course, the overall stock return, its yield over the last 30 years is 3.8% and 3.3% over the last 12 months, which of course is over double the S&P 500's return with dividends at 1.4. Putting it another way, for every $1,000 you invested, you get $33 back in dividends over the past year compared to only $14 that we did see with the S&P fund. Now, of course, this has a rock bottom expense ratio, which you have to be really cognizant and aware of, 0.06%, which of course enables investors to keep a lot more of the dividends for themselves versus the cost of actually holding this fund. Like many dividend stocks, the fund makes quarterly distributions to all of its investors. Looking at the second ETF to buy for May of 2024, High Quality Junk, which is the Spider Portfolio High Yield Bond ETF, providing investors access to high yield or essentially junk bonds. Now, majority of individuals, again, will not and do not go out and search out junk bonds themselves. But when you look at this, junk bonds carry a very high default risk, which can be a little bit scarier than those investment grade bonds. However, they do offer a higher risk, higher reward. They are giving a much higher yield than we normally see. This passively managed ETF tracks the ICE Bank of America US High Yield Index. Now, of course, this ETF holds 1,900 bonds. So just north of 1,900 bonds in here. That provides investors with a diversification and an exposure to the high yield bond market, which of course can give you a very, very good return. Now, when we think of what we're provided from the SCHD, this ETF's annualized return on the last distribution was 8%. That is right. When you start thinking of high yield savings accounts at 5%, when you look at CDs, roughly 5%, this is giving you an annualized return of 8%, while the yield over the past 12 months was 7.7. It is also a very, very low expense ratio with a 0.05. And it is very interesting to see. I never thought of thinking of ETFs when it comes to high quality junk bonds. Very interesting to see that the bond income, again, little bit more risk within this, but overall, if you even have some bonds that are underperforming or some bonds essentially that are higher or lower, you're still getting kind of the best of both worlds because you have the mitigation of holding over 1,900 bonds within this ETF. And the final one with the top 3 ETFs is a premium income stream. This is, of course, the JP Morgan NASDAQ Equity Premium Income ETF. This, of course, is an actively managed fund where both of the other ETFs that we're talking about were kind of passively managed. They put it into a fund and that is where it stays. Now, this, of course, is providing monthly income. This is also aimed to provide exposure to the NASDAQ 100 index with a lot less volatility. Now, both of the other ones that we are looking at pay on a quarterly basis. This one, very similar to like we have the JEPI, pay on a monthly basis. So the ETF in this one has a dual strategy. It holds an underlying equity portfolio that managers select based on a combination of data science, fundamental research, while the fund focuses on stocks in the NASDAQ 100, like we said, doesn't aim to match the index allocations precisely, but it is pretty interesting because very similar to, again, what we've seen with that JEPI. On top of that, it is the calls. They're right on the money. So there is call options of the NASDAQ 100, which is how it generates the income for this is the call options. And again, this is very similar to that we've seen with some of the other ETFs. Fund strategy generates meaningful income. It has delivered 9.2% annual yield over the past month and 10.8% over the past year. Again, when you think big picture, you're over doubling what you're getting in those high interest savings accounts, those high yield savings accounts, also doubling what you're getting for CD rates, providing a 10.8% over the past year. Meanwhile, the actively managed funds is very competitive ETF expense ratio, 0.35, so significantly higher than we've seen before. But again, this is generating income for you on a monthly basis. Now, these, of course, are only 3 top ETFs that we are kind of talking about in May. There are a ton of additional ETFs that will perform exceptionally well, but these were kind of pinpointed. And again, MSN.com really looking at the savings investing strategy. It is an excellent way to start generating passive income this month. So essentially, big picture thinking of how to do this is putting something into, let's say, the VOO and the VUG. You're going to get to the point of carrying a heavily weighted index or a heavily weighted ETF. That is going to be the growth factor. So if you're looking at 10, 20, 30, 40 years, it is going to be the growth that you're seeing within the market that you want to take advantage of. However, when you start getting to the income generation, when you start getting into the passive income, what you have and essentially what you're building in that growth factor, you can shift over to some of these ETFs and they're going to yield you a passive income stream, not only on a monthly basis, you can also get it on a quarterly basis. And that is kind of the transition between the big high growth factor that we do see and getting to the point of seeing the income generation with, of course, ETFs, which is very easy to start collecting that passive income. The SCHD, the Spider High Portfolio Dividend Bond Yield, and also the JP Morgan Income Premium stand out as some of the very top options for, again, May of 2024. They offer high yield income streams. They have very low cost ratios, making them ideal for investors who are starting to build passive income streams. Now, of course, when it comes to passive income streams, not only your primary job, but you want secondary, you want 3, you want 5, you want 7 passive income streams. Essentially, that will grow to the point, especially in investment accounts, where it's going to eclipse the income that you're generating from your regular 9 to 5, meaning that when you do retire, you can actually replace your income sometimes in its entirety or even more income than what you generated while you were actually working. And of course, guys, if you like the content that I'm putting out, go ahead and subscribe to the channel. Let me know in the comments what you guys think and give it a thumbs up. But generating passive income is super important, like we've talked about before. When you get to the point of getting Social Security, getting ready to retire, Social Security provides and essentially is built to replace 40% of your income, which means it is up to you to replace the other 60% of income that Social Security will not provide when you get out of that 9 to 5 grind. So again, guys, that is going to do it for today's video. Let me know in the comments what you guys think. And as always, thank you guys for watching.